Good afternoon, everyone. My name is Tom Banky, and I'm the Manager of Communications and Development here at Forward Community Investments, and I would like to welcome you to today's webinar, Opportunity Zones and Nonprofits with Hamang Patel of Michael Best. Forward Community Investments is a community developmental financial institution that serves the entire state of Wisconsin. We are an investor, connector, and advisor for organizations and initiatives that reduce racial inequities and socioeconomic disparities in Wisconsin communities. We are able to accomplish this through community financing, community development services, and grant making. For more information regarding FCI and all that we do, I invite you to visit our website at www.forwardci.org. At this time, I wanted to go over a couple quick housekeeping notes with you. We want to make this webinar as interactive as possible, so we'll be taking questions throughout the presentation. You can submit them using the chat or questions box located on the right-hand part of your screen in the GoToWebinar toolbar. I will be compiling these questions throughout the webinar and interacting with Mr. Patel as they come through. We will also be recording this presentation for you to access anytime you would like. Once the webinar is live on our website, I will send a follow-up email to all registrants with the link to access the recording, as well as the webinar slides and any additional resources that from Mr. Patel's presentation. Now on to the show. Opportunity zones. Are they the new shiny penny that nonprofits can access to finance their organizations? Or is it the value of opportunity zones to nonprofits overrated? Or is it something in between? Since being introduced as part of the Tax Cuts and Jobs Act of 2017, there have been many conversations about and questions related to opportunity zones. Simply put, opportunity zones offer tax breaks on capital gains income for investing in designated opportunity zones across the United States. In Wisconsin, there are 120 designated zones and 8,700 opportunity zones in all 50 states, territories, and the District of Columbia. Until several weeks ago, there were no guidelines in place to regulate these opportunity zones. In late October, that changed when the IRS released the first round of regulations governing their use. And we have Mr. Patel to talk about that for us. So once again, thank you all for joining us. And at this point, I'd like to turn the presentation over to Mr. Patel.
Thanks, Tom. Thank you, everyone, for joining. So as Tom mentioned, what we'll cover in the next hour are opportunity zones, and in particular explain how this program can be used for nonprofits. And we'll save some time at the end of the program for questions. But what I was thinking we would do is first, I know there's some of you who already are well versed in this program, others who are relatively new to it, and some in between. So what I thought I'd do is first describe the program, what the tax benefits are, how it's structured, and kind of what the investment parameters are before we then turn to how the program interacts with nonprofits. So with that, let's maybe step back and just do a high-level overview of the program. So this was something that was created last December as part of the larger Tax Act. It created a entirely new section of the Internal Revenue Code, and the objective of the program is to spur investment in distressed communities by providing tax benefits to investors. This is something that was championed by Senator Tim Scott of South Carolina and Cory Booker. They had previously introduced legislation for a concept similar to what ended up being embedded in the December Tax Act. And the overall concept of this program is to provide a tax benefit for taxpayers who have generated capital gain and then want to reinvest proceeds into a fund that then deploys those proceeds in a low-income community. So it's somewhat of a hybrid between a number of tax programs that many of us might be familiar with, such as a 1031 program, new market tax credits, and the Section 1202 capital gain exclusion. In many ways, this is a hybrid of some of those things with a few added twists that are unique to this program. So on this slide, what I've outlined is kind of in a diagram showing what the flow of funds. And the starting point is you have to start with a taxpayer that has sold something generating capital gains to an unrelated party. For parties that have not generated some kind of capital gain, this program does not provide any tax advantages to such persons. So the idea is if somebody has sold some property that generates capital gain, and it has to be capital gain, then they can invest cash equal to the amount of that gain or a lesser amount into a fund. And we'll talk about what these funds are and how they're structured. But then what the fund will have to do is invest at least 90% of its assets in qualified opportunity zone property, which can be in the form of stock, partnership interests, or a direct investment in the property. And we'll talk about that in more detail as well as we go through these slides. So going back to what we mentioned earlier, the starting point to all of this is what we need to have is somebody recognizing capital gain. There was some confusion in the original statute about whether it had to be long-term or short-term capital gain. The proposed regulations that came out in October of this year clarified that the gain can be anything that generates capital gains, whether it's short-term or long-term. So that was a welcome clarification. One of the things that was in the statute and continued on in the regulations is that the sale must be to an unrelated party. So a question that we get with some frequency is, can I trigger a gain and then participate in this program by selling to an affiliated company or a family member? And the answer is no. This definition of what is unrelated is a very familiar definition to tax lawyers and accountants. It piggybacks off existing definitions under Section 267 and 707 of the Internal Revenue Code. And getting into those details is far more nuanced than we'll cover in this program. But for those who are interested, that's all spelled out in detail in the statutes and the proposed regulations. So as we mentioned earlier, the starting point is you have somebody that sold something, generates capital gains, and then that person turns around and reinvests the gain into this fund. What's different about this program than some other programs that some of you might be familiar with, such as 1031 exchanges or 1033 exchanges, is the amount that gets reinvested isn't equal to the entire proceeds from the sale of, let's call it our relinquished property. It's just an amount of cash equal to the gain that is recognized. So let's use an example. Let's say I have $1 million of a capital asset. And that capital asset, I should clarify, can be anything. It could be real estate, it could be equipment, it could be stock in a company, or a partnership interest in a LLC or partnership. So let's say I have $1 million of IBM stock that I previously purchased for $300,000, and then I sell it in 2018. I would, if I did nothing, I would recognize $700,000 of capital gain. What this program says is, in this example, where I bought stock for $300,000, sold it for $1 million, recognized $700,000 of gain. In order to enjoy the benefits of this program, all that I would need to do is invest the proceeds up to the amount of gain that I would recognize, which would be $700,000, not the entire $1 million. And then what I need to do is acquire equity in one of these funds. It must be equity, it cannot be debt, but what the regulations did clarify is it could be common or preferred equity. And that distinction is important. We'll talk about this later in the program of why that gives flexibility to these kind of investment structures. There's no maximum or minimum limits to the amount that gets invested into a fund. In my example, I could invest less than $700,000 or more than $700,000. But it the extent that I invest in more than the amount of gain that I recognize sale of that asset, I need to trace that investment separately and don't enjoy the benefits under this program. If I invest in less than the amount of gain, well, that's okay too. Then I'll have some amount of gain that's recognized upon the sale of that asset. So what I haven't gotten into yet is why would somebody want to do this? Well, let's talk about the benefits here. I like to think about the benefits under the Opportunity Zone program as really fitting into three buckets. The first bucket is a deferral of gain. The second is a reduction in the amount of gain
Mr. Patel?
Deferred. Yeah.
So this is Tom, the organizer. We're having a hard time. Your audio is kind of cutting in and out. And I'm wondering if we can try a different tact. I believe that you're using your computer speakers for that. Is that correct?
I'm actually using my phone.
You are? Okay.
Here, let me try this.
I was on a wireless headset as I'm on my... Is this any better?
Yes, that actually sounds great.
Okay.
Thank you. Sorry about that, everyone.
And Tom, let me know if this doesn't do the trick.
Of course, yeah, it's working right now.
The idea is, as I was saying, there's three buckets. There's a deferral of gain. There is the reduction of the amount of gain recognized, and then ultimately there's a potential for exclusion of gain. In that order. The deferral of gain idea under this program is that if somebody invests in one of these own funds, they can defer the date that they recognize gain until the sooner of when they cash out of their fund investment, or December 31st. The other, so right off the bat, that's something. Because all things being equal, people would always rather pay tax later than sooner. But there's something else. It says that if someone holds on to their equity in the fund for at least 5 years, then in 26 or sooner, if they cash out sooner, the amount of gain is reduced by 10%. If they've held it for at least 7 years, then the amount of gain is reduced by an extra 5% for a total of 15%. So there's value, right? You participant in this program can push back the date when the gain is recognized, and when that gain is recognized, which is no later than 2026, the amount of gain is less than would otherwise be the case. But wait, there's more. What the program also allows for is an exclusion of gain. Sorry about that. Go back. Yeah. So if the investment was held for at least 10 years and then is cashed out, the program allows the taxpayer to exclude all of the gain from that subsequent sale of the Opportunity Zone fund. There was some ambiguity in the statute about when that 10-year clock needs to start. There was a lot of confusion that it needed to start by the end of this year in order to get the full 10-year step up. What the proposed regulations clarified is two things. One, that 10-year exclusion could apply to anything, any investment in an Opportunity Zone fund prior to or before June of 2027. They get that date. Well, remember, any gain needs to be recognized not later than the end of 2026. There's a 180-day period for taxpayers to roll over relinquished property proceeds into one of these funds. So that's how they got the June of 2027 date. And then what was new in the proposed regulations is an outer limit on when the taxpayer needs to cash out of the investment in the Opportunity Zone fund. And they picked a date of December 31st, 2047, which for most of most taxpayers is not going to be an issue, but for some circumstances that could be. So we just have to keep an eye on that. So that gives us a lot of flexibility. So let's think about it. Let's say somebody sold a capital asset this year and invested it in a fund and held that fund for at least 10 years. Now, in that example, the taxpayer would have no capital gain in 2018, would recognize that capital gain in 2026, would have a reduced amount of capital in that 2026 tax year, and then later, more the investment was made, the taxpayer could sell that equity interest and not have a capital gain on the proceeds. So with the passage of time, this program becomes less and less valuable. So because think about a taxpayer that's selling an asset in January of 2026, there's no opportunity to hold it for at least 5 or 7 years before 2026. So there's no write down of the capital gain. There's no benefit of deferral because at that point, remember you can defer it at most up until 2026. But at least a taxpayer can say, well, at least I'm in the program and before June of 2027, and if I hold it for 10 years, I can get the capital gain exclusion. So, like I said, with the passage of time, this program becomes less attractive to a taxpayer, and then after June of 2027, there's no further ability to make a new investment in an opportunity zone fund and enjoy these tax benefits. So as we mentioned before, taxpayers can elect to defer the tax on some or all of the gain from the sale of that relinquished property. The proposed regulations added details on how the deferral election is made. I won't go into detail during this program so that we can get to some of the structures later, but those details are in the slides, which I understand will be available. One of the things that the proposed regulations did clarify is they don't want to see any double dipping, which means that a taxpayer can invest in multiple funds with respect to the proceeds from the sale of a relinquished property. But when you make an election with respect to a fund, you can't also then double up on that investment. Hopefully that should be obvious to everyone. One of the other things is clarified by the proposed regulations, which settled an ambiguity in the statute, is what to do with pass-throughs. So let's say somebody is an owner of a partnership or an LLC. Well, the entity itself can make the deferral election and participate in a fund. If the partnership fails to elect, then any or all of the owners of that partnership or LLC can separately make the election. And similar rules apply to other pass-throughs like S corporations and estates and trusts. And so that gives a good bit of flexibility to pass-through structures. As we mentioned before, additional investments above and beyond the amount of the gain recognized can be invested in these funds. You just don't qualify for the program tax benefits. And I should step back and make sure that at its core here, this is a program that has some special tax elections that have to be made for investments in funds. But at its core, this is simply a private offering of equity in a fund that's going to take cash from investors and invest in certain types of properties here. There's no requirement that the only owners of these funds be persons who participate in this program. There's a requirement that any of the owners don't put in extra dollars. So you could have a scenario where a fund might be investing in some property, and investors like just the pure cash-on-cash return that's being generated from that fund, and want to put in dollars that are unconnected with the sale of a capital asset sale, or above and beyond the proceeds received from the sale of that capital asset. And that's perfectly fine. Those persons can get a pure cash-on-cash return from that fund investment. It's just that you don't recognize the additional benefits. An analogy that I would use for those in Wisconsin that have invested in early-stage companies is the Wisconsin Act 255 early-stage company tax credit, where investors in certain early-stage high-growth companies that have been certified by the state of Wisconsin get a state tax credit. But the underlying investment needs to be a good one, and these investors are investing in this early-stage company because they like the underlying fundamentals, but then there's also a tax benefit. And our expectation is that that's how most investors will see these opportunity zone funds. At their core, they need to be good investments, but then there's a sweetener for being able to tap into these benefits under the tax program. One of the things that was clarified in the proposed regulations is what happens if a fund what happens if an investor cashes out of a fund? Can they redeploy the proceeds into investment in a new fund? And the answer is yes. We're still waiting for guidance from Treasury on how exactly that would work, but they have signaled that would be possible, which will, again, give some flexibility here to potential investments.
Mr. Patel, I do have one quick question. We have one question coming in. Are investors in qualified opportunity funds required to be accredited investors?
It's actually an excellent question. I'll talk more about that later, but let me answer that question now. The answer is maybe, because what we're talking about here is simply a private offering of equity in a fund. What we're seeing are structures where some of these funds will have a single owner, others will have a group of related owners, others will be funds that go out and act like what we would kind of think of as classic funds that do an offering document to strangers and solicit investments. The answer is it kind of depends on which securities law exemption you're going to tap into, because this is a tax program. It does not override any of the securities laws that might apply for federal or state purposes. And so the question was, do these people need to be accredited investors, which for are not familiar with the term, essentially means certain types of high net worth investors or people who have large income or otherwise sophisticated. And that is one of several exemptions from requiring that the fund be registered with the SEC. What we do is for funds that go out and do an offering to unrelated parties or people other than the sponsor of the fund, that's probably going to be a typical securities law exemption that is relied upon. But we are seeing structures, I know it's cheating by skipping ahead to what we'll talk about later. We're seeing structures where an organization wants to develop a new facility, and they will structure the special purpose entity that will own that facility to be an opportunity zone fund, and then can deploy their own proceeds from affiliated entities into this fund. For example, let's say you have a manufacturer that's selling one site, cashing out, and then building a manufacturing facility on another site. We actually have a client that is looking at that very structure and running the proceeds through this program. And in that scenario, where the owners of the fund are all affiliated with the sponsor of the fund, no, you don't have to worry about a accredited investor status. But when you're going out and raising money from third parties, yes, we would expect most of those investors to meet that threshold.
Great, thank you, Mr. Patel. I do have one more question before you get back, or did you want to finish your thought? I'm sorry.
Sure.
Okay.
No, please go.
With regards to the pass-through example, if a partner in an LLC wants to invest in an opportunity zone, do they get additional time to invest their share if the partnership does not opt to invest?
Yeah, good question. I didn't touch on that. What the proposed regulations say is the partner still has to comply with that 180-day rollover period. That period starts on the last day of the partnership's tax year, but special rules will allow the partner's 180-day period to commence sooner if the partnership gives notice. So the question that I've been getting is a lot of times passive investors in a pass-through won't know whether or not the partnership made this election or not until closer to when they would otherwise be entitled to get the financial information or their K-1s from that pass-through entity, which wouldn't be until spring, right? And if that 180-day period starts on the last day of the partnership's tax year, the partnership's tax year ends December 31st. Well, now that's eating into the 180-day period that the individual partners would otherwise be able to make this election. So what that's going to do is create some communication needs between the partnership and the various partners for when notice is given about the partnership's decision. And what we expect is that depending on what role our clients play, is we're going to have to look for that kind of communication rights in the operating agreement or the partnership agreement of the pass-through entity. So good question.
Great, thank you. And on with the show, I guess.
Yeah. Okay. So let's talk about these funds and what the investment parameters are, because again, there's a lot of tax rules here, but ultimately these are really just investment parameters for a fund. So we start with what are these zones themselves? Well, they are low-income community census tracts. For those who are familiar with the New Market Tax Credit Program, it's that same definition, but what the states did is take about a quarter of those qualifying census tracts and then nominate them to the feds. Have already all been set. So sometimes we get questions of somebody not in a opportunity zone. Is there any ability for me to write my congressperson or senator and get in? The answer is no. Those lines are fixed. You can access a list of those zones by going to a Department of Treasury website. I know there's several links. A lot of state organizations will also have links. I have a link in this program to one that's at the CDFI website that does a nice mapping feature. Again, for those familiar with some of their other programs, it's the same mapping software with the opportunity zone overlay. Let's talk about the funds themselves. The funds can be either a corporation or an LLC. It has to be a domestic entity. It can be existing or new, but the purpose must be to invest in opportunity zone property. The big catch here is these funds must hold at least 90% of their assets in qualified opportunity zone property. And these tests are, it's somewhat of a complicated test. That test gets measured twice a year. And so there's not a lot of time for these funds to sit on cash. There's a few safe harbors that I'll talk about in a few minutes, but it'll put limits on some of these funds being set up to go do an offering, pull in a lot of cash into some kind of blind pool fund like we might be familiar with for other types of investment funds or REITs or the like, and then go hunt for qualifying properties, because again, they'll have at most half a year before they turn that cash into qualified property. In talking to other people, other advisors, and investors and the developers, what we're expecting is for many of these funds, they will either do staged investments or structure it so that the investments are geared to be specifically invested in identified properties rather than pool a lot of cash and then in some kind of like blind pool and then seek to deploy it. One of the things that was clarified after the statute came out is the certification process is much simpler than what we might see in some other tax programs. This is one where these funds self-certify without need for any kind of approval or action by the IRS. It's almost like making an S-corp election where you just fill out a form and send it into the IRS. The proposed regulations identified the form that would be used, and I give some detail about that in the slides. The timing of when you make this election is important. One of the things that the proposed regulations clarified is that funds can choose when they start the clock ticking on meeting that 90% test. And that will be really helpful for existing entities that want to now be qualified as a fund and structure their affairs so that they will meet that 90% test. It gives some planning opportunity for existing entities. One of the things that the program is completely silent about is what the management of these funds look like. It's completely silent. The fund manager can take whatever kind of fees that it wants, whatever kind of carried interest it wants, but the caveat has to be the manager can't get so greedy so that it takes away too much cash flow from these investors. Otherwise, the expectation is when there are unrelated investors in one of these funds, too much cash flow going to the manager or the sponsor will reduce the attractiveness of these funds. And what we would expect is that there will be quite a few funds that will start popping up in the coming weeks and months all over the country. Some will be national in scope, some will be regional, some will be focused on different kinds of assets. Really no different than what we've seen historically with REITs or other kinds of investment funds. They'll all have their own focus, but for an investor that's looking at putting money into one of these funds, the appeal of one fund versus another will depend on the wherewithal of the team to make good on their investment promises. So you kind of size up that management team, or if it's contracted out, whoever the contractor is, but then also what the fees are, because our expectation is investors in this program will be looking for the tax benefits, but also just a pure cash return on their investment. So these funds, they go out and they have to invest in qualified opportunity zone property, which can be equity in a corporation, in an entity treated as a partnership, or a direct investment in property. What's missing here in this list is a debt instrument. And in fact, a debt instrument is specifically not a qualifying asset. And so this will create a serious limitation on potential users of this program, in particular, nonprofits. Because just to repeat what we said here, these funds have to take equity interest in the users of the fund, or have actual title to the underlying property. Based on the guidance that we have as of yet, there's not an ability for one of these funds to take in investor money and then enter into some kind of lending business akin to what a community development entity in the New Market Tax Credit Program would do. That's not the way this program is structured. So for some types of projects where, like let's say a developer is pulling together some kind of commercial real estate project, and as part of the capital stack, what that developer would do is put in some of its own money, go to a bank, borrow some money, and then do a private offering to sell off a portion of the equity interest in special purpose entity. Hey, the Opportunity Zone program is a great alternative to just doing a traditional private offering. In fact, it is a private offering, but under the Opportunity Zone program. For nonprofit, however, it's by definition the nonprofit cannot sell off a part of the equity interest of the nonprofit, right? There is no equity to be sold. The nonprofit cannot have part of its property be co-owned. So that creates some limitations. There are some ways that I'll say for later on, but that will be a serious limitation on the use of this program by nonprofits. Like we were saying, the stock or partnership interest, it has to be in a domestic core partnership or LLC and acquired for cash at original issue. If we're talking about property, what the fund needs to own is stuff that it can touch. It has to be tangible property, not intangible property. It can be equipment or real property or any other types of personal property, but it has to be used in a trade or business, and that's going to be a major caveat for a lot of potential users of the program. The other caveat is that property either first has to get used within the fund, or what the fund needs to do is buy property and then substantially improve it. And by substantially improve it, what we want to see is that the fund essentially buys property and then doubles the value of it. There's rules saying that substantially all the use of that property must actually physically be in one of these opportunity zones for substantially all of the fund's holding period. And by substantially all, the proposed regs said look to a 70% standard. So as I mentioned a moment ago, if there's a substantial improvement, what the rules want to do is see that what you've done is you've taken like a building, for example, and then make major improvements to the building that essentially double the value, backing out the value of the underlying land. For nonprofits that are rehabilitating older buildings or taking existing machinery and refurbishing it, that's where this program could work. For those that would look to acquire an existing completed building that has already been placed in service, the program doesn't quite fit that type of an investment. The question that comes up a lot is, what if the fund takes in cash and then wants to use it for building some real estate project, for example, or constructing some asset? There is a safe harbor that came out in these rules last month that give a 31-month safe harbor for turning cash into construction projects. There needs to be a written plan evidencing this process. So there's a good bit of parameters that will need to be met, but it otherwise makes possible what would otherwise be impossible, because there's practically no way for most construction projects to start and finish within that 6-month testing window that would otherwise be the case. But cash generally is a problem unless it's being earmarked for these kind of improvements. I'm going to skip ahead to some of the other issues.
Mr. Patel?
Yeah.
One quick inquiry was discussing, wondering if you're going to be covering exit strategies for investors.
Yeah, sure, I will. Well, why don't I touch on it now? So the question that often comes up is, how do investors get out? And the answer is the same way investors get out of existing funds that have been around for a century now. Most of these funds that we classically see will have an investment period of 3, 5, sometimes 7 years. In this program, what we would expect is that time period to get pushed out to something like 10 years, so that investors can benefit from the that 10-year exclusion rule. But at the end of that 10-year period, what the fund is going to want to do is cash out of its investments and then send the cash out to the investors. And like existing funds are structured, these funds will want to have a little bit of leeway to say, well, we're working on it, but we don't have to do a fire sale right at that 10-year mark. One thing that I should point out for these investors is, let's say somebody invests in one of these funds in 2018. Well, in 2026, there's that deferred tax that will come due. But if you structure this the way that you would want, your money's going to be locked up until, in our example, 2028, right? 10 years after the first investment. So an investor will need to source the payment of that deferred tax from cash on hand from other sources. Another question that often gets asked is, well, what if I want to pull my money out of these funds early? And the answer is going to be the same answer that applies to any kind of investment fund investment today or in the decades in the past when these funds have been around, and that is this is not publicly traded stock. It's rare for funds to be willing to cash an investor out unless that's something that's negotiated up front. So when most of these investors are going into unrelated funds where the manager or the sponsor is not affiliated with the investor, these investors need to understand that their money can be locked up for an extended period of time. So just a few things I want to cover before turning to focus on nonprofits is the assets that we're talking about here actually have to be in one of these opportunity zones, which is going to put limits on organizations that are operating nationally or regionally. It will make sense for like building projects where the projects are isolated into a special purpose entity, and all of the assets are in one of these opportunity zones. But for let's say an organization that wants to buy, I don't know, like something that will move around the country, like vehicles or trucks, and use them in some kind of operation regionally or nationally, I think there could be concerns with being able to identify that the property is being used in an opportunity zone. Like what we see with tax-exempt bonds and the New Market Program, there are certain sin businesses that are prohibited. For most nonprofits, this won't be an issue. As we talked about before, these funds can be single purpose or single investment. There's quite a bit of flexibility there. It'll really depend on the structure. No minimum or maximum number of investors in the fund. There's a nasty compliance penalty if the fund doesn't meet that 90% requirement. There is a penalty that would be assessed, but there's a reasonable cause exception if there's a foot fault. Sometimes we get asked the question, well, is there a downside of doing this? Because if somebody's going to otherwise form an entity, why not just have it be certified as a fund? And the answer is, well, if you move forward with this program, there's not currently a wherewithal to say, well, now I'm just going to exit it. Rather, you would have the penalty that would be imposed if you fail to meet that 90% test. We talked about securities laws earlier. Proposed regulations were issued, and the IRS is seeking comments right now. I think, as we've mentioned before, this program interacts well with other tax incentives like new markets, low-income housing, historics. I don't want to spend too much time on that now, because what I'd like to do is skip ahead to talking about how this interacts with nonprofits. So there's a few ways that we're thinking about nonprofits participating. One is to be a fund manager. The other is to be a user of these proceeds. A nonprofit can create its own fund, but all the requirements of tax exemption that we're all familiar with for nonprofits still apply with equal weight. And the thing that the nonprofit will have to ask is, how does this fit with the tax exempt mission? You need to make sure that what the fund is doing is aligned with what the nonprofit is seeking to do. A number of years ago, we were working with a nonprofit that wanted to start an investment fund to invest in early stage companies in a particular industry. And these companies were not necessarily disadvantaged or otherwise meeting the indicia that would help a nonprofit argue that its activities are charitable. And it was working with, it put in an application or a tax exemption application saying, hey, we're going to form this organization, and what it'll do is invest in companies and take in investment from third parties. And to be honest, we had a bear of a time getting the IRS to agree with that. They said, look, you're just running a commercial investment fund business. We don't see why this is charitable because you don't otherwise meet the disadvantaged or other types of economic development criteria that's traditionally applicable. And so we ended up making that work because we used a lessening of governmental burdens argument. But I say that story because if you're a nonprofit and you want to be a fund manager, you still have to make this fit within the classic tax exempt mission. And you can rely on a lessening of governmental burdens type argument. You might be able to rely on a charitable argument saying what you're doing is economic development in that traditional sense, or working with disadvantaged companies that meet certain racial or other parameters that have been accepted by the IRS. But you have to think about that. You also have to think about unrelated business taxable income issues from any kind of fees or carried interest that the nonprofit might seek to use. There's not going to be any kind of safe harbor with this program that you can lean on. You have to lean on the existing parameters that have been built up over the decades to protect a nonprofit from unrelated business income tax. The other scenario that we will see with some regularity is a nonprofit wanting to be a user of Opportunity Zone funds. And in this slide, I say, well, what if somebody wants to build a new facility? How do they use it? Well, as we've talked about before, a nonprofit can't give away equity in their company because there is no equity by definition. So the structure that we would envision is one of two scenarios. Either the fund actually owns the new building or the new equipment that the nonprofit wants to develop or acquire, and then leases it to the nonprofit under what the IRS would call a true lease. And then the nonprofit leases it for 10 years, and then after that 10-year mark, or whatever point is negotiated with the Opportunity Fund, the nonprofit then purchases the tangible property for fair market value, and that's going to be something that will have to be explained to the nonprofits. That what a nonprofit will typically want is to be able to get that property for a de minimis amount of cash at the end of that lease period. The problem with that is it would convert this lease to what the IRS calls a financing, what's sometimes referred to as a capital lease under accounting concepts, because of that bargain purchase component. In order to be respected as a true lease, that lease needs to be one where the tenant's right to purchase is only at fair market value, measured at that later point in time. Why does it need to be structured this way, you might ask? And the answer is, if it was structured as a financing, then what the Opportunity Fund would hold is the equivalent of an installment note, because the IRS would view this structure as the Opportunity Fund acquiring this property and then selling it to the nonprofit. And the nonprofit might get comfortable with that, saying, well, my deemed purchase price is fair market value. But the opportunity fund would have a problem because that installment note is not a good eligible asset. It is what the IRS calls non-qualified financial property and would cause the opportunity zone to count that against its 90% test. And so through this program, what an opportunity zone would need to do is either own the property directly and then do a true lease to the nonprofit, or perhaps co-invest with the nonprofit in a new corporation or a new LLC that would use combined funds from the nonprofit and the opportunity fund to acquire the property, but then again lease it back to the nonprofit. So for a lot of nonprofits, this is going to be a limitation on how they would otherwise like to structure the program. In a perfect world, what the nonprofit would do is have this fund acquire the property and essentially give it to the nonprofit at some period of time. It's no different than structures that nonprofits have tapped into in other tax programs like the New Market Tax Credit Program. That type of flexibility will be hard to sustain under this program unless we get some guidance from Treasury that changes the rules that we're otherwise familiar with. In these slides, I won't go into a lot of detail, but slide number 45 talks about what's needed for a true lease under kind of traditional leasing standards. One thing that a nonprofit could do is to say, well, okay, it's not going to tap into this program, but what if it wants, part of its mission is to co-invest? Can it do that? Sure, it can do that as long as it's meeting the other standards that all nonprofits have to comply with for entering into lending programs. But again, that's nothing new under the sun here. That's nothing specific to the Opportunity Zone program. I mentioned this just because I'm getting this question quite a bit. But again, you just need to keep in mind that's something that nonprofits have been able to do and can still do, whether in this alongside this program or otherwise. I know I'm getting towards the end of the hour here, so why don't I pause there and take some questions?
Sure. So if actually none have come through as of right now since that last one that I did ask, but so we'll just make that call right now that if you do have any questions, feel free to send them via the questions or chat feature on the GoToWebinar bar. So feel free to do that. Let's see here. We did have, okay, so let me, so we have, okay. One question that came through is how has, do you see Opportunity Zone funds investing in multiple types of investments, early stage or real estate? Early stage companies or real estate?
Yeah, good question. Real estate, yes. Early stage companies, sort of. I don't see a realistic scenario where an Opportunity Zone fund would invest in the equity of an early stage company in like a so-called Series A, B, C, or other types of rounds of financing, because your typical early stage company won't want to be localized to just one point, right? Take your typical tech company or other fast-growing early-stage company. They want to go global and become the next Amazon or Google or Facebook or whatever. And they're not going to want to be just a local company that does its activities in that opportunity zone. But what we could do is, let's say you have an early-stage company that needs to build a manufacturing facility. What the fund could do is provide an equity alternative to that early stage company and say, look, you need to build, for example, I'm making up numbers here, you need to build a $10 million manufacturing or distribution facility for your business. you want to site it in an opportunity zone. You can come up with some kind of combination of your own equity or debt to build this facility. But why don't we use the Opportunity Zone Fund to provide the equity component, and it will own the facility, lease it to the early stage business, and then after 10 years, what the early stage business can decide is whether they want to then buy out that facility or not, or maybe move on to a larger facility or a facility elsewhere, and then the fund can then just cash out of that investment and sell it on the market. That's a possibility. And then turning this back to nonprofits, again, that's something that could be a model for a nonprofit. And the question that I got was, why would a nonprofit do this? Because at the end of that 10 or whatever year period, the nonprofit still has to buy this facility if they want to use it. And the answer is it defers the time when the nonprofit has to go do a capital campaign to raise the dollars that would supplement any debt financing that would be incurred. You're tapping into the Opportunity Zone investment dollars that would provide the equity component of your capital stack. And sure, at some point, you'll probably need to rely on a capital campaign or other donor dollars to help cash out that investment. But you push that point in time out into the future. And what you have to do is balance that deferral benefits against the risk that the underlying property will appreciate in value so much over that period that that your deferral benefits no longer outweigh the larger amount of the payment that you'll have to make to acquire that property after after the nonprofit buys it from the fund.
All right. Thank you. That's a great answer. So we have a few more that are rolling in. One quick one. Are there any estimates for when the IRS will finalize the regulations?
There's not. Looking at history, sometimes they've been finalized shortly after. There's a hearing that's coming up in the first quarter of 2019. The hope is that they'll be finalized soon after that, but there are proposed regulations that have been sitting on the books for decades in other contexts, in other statutes in the Internal Revenue Code. So there's no guarantee that it's going to be anytime soon. But at least the good thing is the proposed regulations did say that they can be relied upon until until final regulations come out. So we're not completely in the dark at this point.
Great, thank you. So kind of moving on to a few other questions. Is there a possible correlation with opportunity zones and CRA legislation? If banks are required under CRA to invest in service neighborhoods, could this fund increase desire for more investments in those neighborhoods?
Yeah, excellent question. That's getting a lot of attention right now. I know some of my colleagues who do government relations work are working on that. I do understand that the Community Reinvestment Act is being revisited, and a number of organizations have petitioned to have investments in Opportunity Zone funds count towards the CRA credit. I know that I'm not the CRA expert here. Some of my banking colleagues are ones I usually lean on for that, but I understand that even as of now, there is a way for certain banks to get CRA credit, but it's just not as straightforward as they would hope. The hope and the goal is that the amendments to the program will provide a tighter link to this program, which, if that happens, would be likely to steer quite a few dollars towards the Opportunity Zone program. But we all just have to keep watching how that plays out.
Great. I'll ask you one more question because we're running up against our time here. But for those who did ask questions that weren't answered, what we'll do is I will compile those and send those off to Mr. Patel along with your email address, and then we can respond that way. So the last question is that, so do you know whether Wisconsin has harmonized its tax code to the federal tax code? If I sell an investment in Wisconsin that produces a gain, I have federal and Wisconsin capital gains tax liability. If the gains are invested in an opportunities fund, the gains are deferred under federal tax code. But are they also deferred under Wisconsin tax code? And if so, must the opportunity zone properties be located in the state of Wisconsin?
Yeah, I'll do that one backwards. The opportunity zone properties don't have to be in Wisconsin as we know it now. The way the Wisconsin state tax works is it's based on the federal. It's based on the Internal Revenue Code. Then with modifications, we would typically expect every time that there are major changes that the state would tweak it. They'll take some, won't take others. We haven't seen any evidence of them backing out opportunity zones like they have backed out some other federal tax incentives. But that's an excellent question. It's something that we need to keep an eye on to see whether or not Wisconsin will opt out of this program or not. We have seen with the state back out other federal tax benefits in other contexts. So it's certainly something that bears watching.
Great. Well, at this point, we're going to wrap things up, and I want to thank everyone for joining today's presentation and taking time out of their busy day. Another special thanks to Mr. Patel for his hard work in putting this presentation together and responding to all the questions. As I mentioned in the introduction, an email will be sent to you all later this week that includes the recording of the presentation, the webinar slides, and then additional resources as well. So thank you again for joining us. Have a great day. Hope all is well, and we will be in touch. Thanks again, Mr. Patel.
Thank you.